All right, welcome everyone. Today we're going to jump right into the world of fixed income and really pull back the curtain on one of the biggest choices for investors, the difference between corporate bonds and government bonds. So let's get to it.
So, have you ever found yourself thinking this? Looking for a way to grow your money, but without all the drama of the stock market. If that roller coaster isn't for you, well, you're in exactly the right place. Bonds are designed to solve this very problem.
Okay, so what is a bond, really? When you strip it all the way, it's actually super simple. Just think of it like an IOU. When you buy a bond, you're not buying a piece of a company, like a stock. Nope, you're simply lending money to an organization, and in return, they promise to pay you back. And here's how that IOU actually plays out. It's a three-step dance, really. First, you lend them some money. That's called the principal. Second, in exchange for your loan, they pay you regular interest. That's called the coupon. And third, on a specific day in the future, the maturity date, you get your original money, your principal, back. That's it. All right, so who's on the other end of that loan? Who are these borrowers? Well, in the huge universe of bonds, it really comes down to two main players who are out there looking for capital. First up, you've got governments. Yep, that's right. When a government needs to fund those huge projects that benefit all of us, we're talking new highways, schools, bridges, you name it, they issue government bonds. So when you buy one, you're literally lending money to help build out the country's infrastructure.
And then, on the flip side, you've got companies, corporations. They issue corporate bonds when they need cash to grow. And this could be for pretty much anything. Building a new factory, pouring money into R&D, or even expanding their business into a new country.
So you've got governments building roads and corporations building, well, everything else. But when it comes to your money, how do you even begin to choose between them? Let's put them head to head and see what really sets them apart for an investor like you.
When you really get down to it, the choice between these two, it all boils down to one single fundamental trade-off. Are you hunting for higher potential returns, or is your main goal the rock-solid safety of your investment?
Okay, this table breaks it down perfectly. Just look at that risk row. See? Corporate bonds. They have a higher risk that the company might not be able to pay you back. That's what we call default risk. But to make up for that risk, look at the returns row. They almost always offer higher interest. Government bonds, on the other hand, are backed by the full faith and credit of the government. That makes them super low risk, but that safety usually means you get lower returns.
Now, here's something that trips people up sometimes. A bond's price isn't just set in stone, it actually moves around. And it has this weird inverse relationship with interest rates. Think of it like a seesaw, right? So if you own a bond that pays 3%, and suddenly new bonds are being issued at 4%, your 3% bond doesn't look so hot anymore, does it? So its price would fall. But if rates drop to 2%, whoa, now your 3% bond is a fantastic deal, and its price will go up.
So what does that tell us? It tells us you absolutely cannot just look at the interest rate and call it a day. There's a whole story underneath, and you got to open up your investor toolkit and do a little homework.
And I absolutely love this quote because it just hits the nail on the head. Picking a bond just by its interest rate, that's exactly like buying a house because you like the color of the paint. The real stuff, the foundation, the structure, it's all inside the bond's offer document.
And one of the first things you should look for in that document is the credit rating. I mean, think of it as a simple score that answers one question. How likely are they to actually pay me back? Independent agencies give these grades. AAA is the gold standard, the safest you can get. As you go down the list, the risk gets higher. And once you hit BB and below, you're in what they call high risk or junk bond territory. Look, I know these documents can look super intimidating, but you can really just boil it down to asking 4 simple questions. First, who are these guys and are their finances in order? Second, why do they want the money? Is it for something exciting, like growth, or are they just trying to pay off old bills? Third, what are the risks here? What could possibly go wrong? And fourth, is this bond backed by any hard assets? That can give you an extra layer of security.
Okay, so now that we have all this info, how do we put it all together and actually make a decision? Let's build a quick framework. Because honestly, knowing yourself as an investor is just as crucial as knowing the investment.
So let's say you're the kind of investor who just really doesn't like risk. Your number one goal is to protect what you put in. If that sounds like you, then government bonds are your go-to. They are the classic choice for stability and peace of mind.
But what if you're okay with a little more risk? If you're willing to take a calculated chance for a bigger payoff? Well, that's when corporate bonds start looking really interesting. You are being paid that higher interest rate because you're willing to accept the higher risk. But you know, for most people, the real answer isn't picking one side. It's not an either-or situation. It's often about using both. By mixing government and corporate bonds, you can balance things out. You get the safety from the government bonds and the higher return potential from the corporate ones. That's diversification in a nutshell.
And that's the bottom line, isn't it? There's no magic one-size-fits-all answer here. It all comes down to what's right for you